Charlie Munger spent decades shaping one of the greatest investment track records in history alongside Warren Buffett at Berkshire Hathaway. His success didn't come from complicated strategies or rapid trading. Instead, it was grounded in a few powerful principles applied consistently over a lifetime. What made Munger exceptional wasn't privileged information or risky bets. It was his disciplined thinking, patience, and willingness to act decisively when the right opportunity appeared. Number 1. Invest in high-quality businesses at reasonable prices. Early in Berkshire Hathaway's history, the focus was on buying undervalued average businesses and selling them once they recovered. Munger challenged this approach and helped shift the strategy toward investing in great businesses for the long term. His reasoning was simple. A great business keeps growing and generating strong returns without constant intervention. In contrast, a mediocre business eventually reaches its limit, forcing investors to move on. A great business at a fair price is superior to a fair business at a great price. This mindset led to long-term investments in companies like Coca-Cola, businesses that could compound value over decades. The goal wasn't to find the cheapest stock, but the best business. Number 2, be patient and act boldly when it matters. Munger believed that most of the time, the best decision is to do nothing. Truly great opportunities are rare, and constantly trading reduces your advantage. Instead, he waited patiently until the odds were clearly in his favor. When those moments arrived, he didn't diversify excessively. He made a few high-conviction investments that drove most of his returns. The big money is not in the buying and selling, but in the waiting. This combination of patience and concentration is difficult to maintain, especially in a market that rewards constant activity. Munger resisted that pressure and stayed disciplined. Number 3, control psychology and avoid big mistakes. Munger understood that poor investment decisions usually come from human emotions, not lack of intelligence. Fear, greed, envy, and overconfidence often lead to costly errors. He studied cognitive biases and built systems to minimize their influence. His focus wasn't on being the smartest investor, but on avoiding major mistakes that could derail long-term growth. It is remarkable how much long-term advantage people have by trying to be consistently not stupid, rather than trying to be very intelligent. This approach required strong self-awareness. Munger knew that a single major mistake could undo years of progress, so he prioritized protecting the downside. Number 4, develop a broad framework of mental models. Most investors rely only on financial knowledge. Munger believed that was limiting. He drew insights from multiple disciplines: psychology, mathematics, biology, history, physics, and economics to make better decisions. He called this a latticework of mental models. By understanding how different systems work, he could recognize patterns others missed. You must know the big ideas in the big disciplines and use them routinely. This approach helped him think in probabilities, anticipate risks, and understand why certain businesses succeed over time, not just how they look on paper. Number 5, protect the power of compounding. Munger viewed compounding as something that needed to be preserved. Frequent trading leads to taxes and costs that quietly erode returns. Reacting to short-term noise can also cause investors to exit great investments too early. His strategy was simple: hold strong businesses for as long as they remain excellent and avoid unnecessary activity. The first rule of compounding: never interrupt it unnecessarily. Compounding may seem slow year to year, but over decades it produces extraordinary results. Munger built his entire approach around protecting this process. Charlie Munger's wealth wasn't built on complexity or speed. It came from a small set of principles applied with discipline over decades. Invest in exceptional businesses. Wait for high probability opportunities. Concentrate when conviction is high. Avoid psychological pitfalls. And let compounding work uninterrupted. Many investors understand these ideas in theory. What set Munger apart was his ability to follow them consistently, even when the market rewarded impatience. In the end, his success reflects the power of clear thinking, long-term discipline, and staying committed to a proven approach.